Welcome to Global Investment Insights, a weekly podcast brought to you by ADCB Asset Management. My name is Kishore Muktinutalapati, an equity strategist for ADCB. With an objective to empower you with investment insights, on this program we discuss various perspectives shaping the global investment landscape. Is a recession inevitable? That is the biggest question facing investors right now. While the question in itself is simple and straightforward, the answer might need to be a more nuanced one. To start with, looking at the bigger picture of an economic cycle, it's always characterized by four distinct phases of expansion, peak, contraction, and trough in the gross domestic product (GDP). The period of contraction in the economic output that lies between the peak and the trough of the GDP is what is called a recession. Now the nuances come in the form of frequency, durability, breadth, and depth of recessions. Let's deal with the frequency and durability for now. First, on the frequency, recessions do happen regularly. Between 1929 and 2008, the United States had 14 recessions. That averages one recession every 5.6 years. The economic expansions that precede recessions come in various lengths. Some could just last a couple of years, while some could last over a decade. For instance, after the recession linked to the global financial crisis of 2008-2009, the US economy enjoyed the longest ever, albeit also the weakest, economic expansion which lasted for about 10.5 years before the COVID-19 related economic shock took place. Even the expansion in the 1990s lasted for about 10 years before ending in the early 2000s recession. However, recessions were more frequent in 1970s and early 1980s. The second distinction to be made is regarding the durability of a recession. Based on the data since 1900, a typical recession in the US lasted for about 15 months, while a typical expansion was about 48 months in duration. Here too, there are differences within the sample. For instance, the COVID-19 related economic contraction lasted just for 2 months, while the Great Depression of the early 1930s lasted for about 43 months. Revisiting the question that we started with, is a recession inevitable? Well, according to the history, it is inevitable. But as per the details we just discussed, how long before a recession strikes and how long will the recession last are the more important questions to ask. To that extent, the question, is a recession inevitable, is vague, incomplete, and to some extent rhetorical. Instead, the question to be asking is, how likely is a recession over the next 12 months? For that, we turn to our data-driven proprietary recession probability indicator, RPI. For details on how we constructed this indicator, please take a listen to our Global Investment Insights podcast episode titled Recession Risks Rising, dated March 22, 2022. After rising 2 percentage points over the past month, our RPI now indicates a 40% probability of recession over the next 12 months in the US. While a sharp rise in recession probabilities this year has caused investor concern, history suggests that the current levels still do not indicate an imminent recession in the US. Key levels to watch on this indicator are 50, 60, 70, and 80 percentages. Major driver of recession fears in the recent months has been the elevated inflation, feeding into the economic outlook through weakening consumer sentiment and higher interest rates. Therefore, should inflation start to normalize from the current elevated levels, recession fears could start to abate too, in our view. Equity market performances are already reflecting a high probability of a recession. Any evidence that points to a fall in recession probabilities should bring immediate relief to risk assets. In summary, while a recession could come at some point in the future, the chances that we will see one in the next 12 months are currently only at 40%. The US Federal Reserve has embarked on a monetary policy tightening, but that does not mean that a soft landing of the economy is not possible. Especially should the oil prices remain well behaved at the current levels or even fall, and the supply side bottlenecks continue to ease, inflation should start to fall in its natural course. That should, in turn, take some pressure off the central banks to raise interest rates sharply. That means that a recession over the next 12 months is not inevitable. Thanks for listening. We hope you found this podcast useful. If you did, please do share this and other episodes with family, friends, and colleagues. For more information on what was discussed on this podcast, please reach out to your contact at ADCB. You can also log on to our website at www.adcbam.com for more information. You've been listening to the Global Investment Insights podcast from ADCB Asset Management, and my name is Kishore Muktinutalapati.